Support for this podcast is provided by Avalara. Since 2004, Avalara's vision has been to harness the power of cloud technology to help simplify sales tax for businesses of all sizes. Collecting tax for the government is something businesses just have to do. But getting the job done efficiently and correctly can be an incredible challenge, because tax rules and regulations can be endlessly complicated. It's an overwhelming task that begs for automation. So Avalara built a cloud-based solution that helps ease this burden, and Avalara scales up with its customers as they grow. With more than 1,000 signed partner integrations, Avalara likely integrates with the ERP, e-commerce, mobile payment, and point-of-sale systems you use today. Find out how your business can be sales tax ready at avalara.com/taxnotes. That's avalara.com/taxnotes. Avalara, tax compliance done right.
Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, tax season kickoff. February 12th marks the start of the 2021 U.S. tax filing season. But this year, much like last year, will be far from normal. First, the IRS announced that the tax season will begin 3 weeks later than in previous years. This is the second filing season since the start of the coronavirus pandemic, and the third since the Tax Cuts and Jobs Act took effect. This has presented taxpayers and practitioners with some familiar, but still unique challenges. Here to talk more about this is Tax Notes senior reporter William Hoffman. Bill, welcome back to the podcast.
Hi, David. Thanks for having me back.
Now, I understand you talked to two practitioners about the 2021 filing season. Can you tell us about them?
Well, first of all, Phyllis Jo Kubey is an enrolled agent based in New York City. She served most recently as chair of the Internal Revenue Service Advisory Council's Wage and Investment Subgroup, working with the tax agency's Wage and Investment Division on implementation of coronavirus emergency tax legislation, such as the CARES Act. Interestingly, Forbes also picked Phyllis's Twitter feed as one of the top 100 to follow in 2021. Ryan Losi is Executive Vice President of PIASCIK, Certified Public Accountants in Richmond, Virginia, leading the company's business development efforts. Ryan also heads the company's international and real estate practices. Before PIASCIK, Ryan worked in international tax at both KPMG and PricewaterhouseCoopers. Ryan's business takes him all over the world, allowing him to indulge a passion for scuba diving, for which he's earned an advanced open water certification to 100 feet deep.
What sort of issues did you get into?
Well, I've been writing tax return filing season coverage at Tax Notes Today for almost 10 years, and this year I wanted to do something different. We recruited these two tax professionals specifically to hear two very different perspectives on this most unusual 2021 filing season. I also wanted to go beyond the routine questions about how this filing season differs from the last and what we can expect this year from the IRS. So our tax professionals talked about the tax agency's response and practitioners' preparations for February 12th, when the IRS will receive almost 1/3 of the individual returns it expects to receive in just one day before April 15th. We also conducted the first Tax Notes podcast Top 10 lightning round of major practitioner IRS filing season issues and challenged our guests to give us their first impressions and thoughts without any advance notice or preparation for the question. It was exciting, at least as exciting as tax filing season podcasts get.
All right, sounds great. Let's go to that interview.
Welcome, Phyllis and Ryan. Thank you for joining us on the Tax Notes podcast. The IRS starts accepting individual tax returns for the 2021 filing season on February 12th, almost 3 weeks late this year. The practitioners have been completing electronic and paper returns and storing them for weeks in advance of submission. Are you worried, given the IRS's disappointing history with technology and long lines, about the agency's ability to receive approximately 40 million tax returns in one day? That's almost 1/3 of the individual returns the IRS would normally receive and process by April 15th. And that's not to mention all the intervening deadlines for corporations, partnerships, and so on. Also, do you have any plans for client issues in case the IRS is unable to promptly process the roughly 37 million returns that it would usually have finished by now? Phyllis, please go first.
Yeah, thanks, Bill. That's a really good question. I do have faith that the IRS has done a lot of troubleshooting on this and they know what to expect. So I would like to give them the thumbs up that we will not have any technological disasters. Of course, one never knows, things do happen. In terms of what I'm doing in my practice, my clientele is not habitually an early filing bunch. So I've pretty much been collecting information as I usually do. Most of my clients' stuff is not yet complete. So I'm working away, and in terms of what I'll be e-filing on the 12th, I think if I submit anything that day, it will be some amended 2019 and prior year returns that I've had in the hopper but haven't been able to transmit.
All right. Brian?
Well, similar to Phyllis, I think the majority of taxpayers will probably experience little to any delay other than the actual 3-week announcement of acceptance of returns that the commissioner made. But like her practice, probably a good 85 to 90% of our clients do not actually file timely returns. We ask for extensions, and whether they're extensions that are available to domestic taxpayers or the special extensions available to international taxpayers, we use those quite a bit. So really the second half of the year is when we file the majority of our returns. And I will tell you, those are the ones I'm more concerned about that the IRS processes correctly. If the 10 months or the last 10 months or 11 months is any indication that the service's ability to process timely, chronologically, in order, amended returns that were filed pre-COVID, also during COVID, as well as applying payments correctly, whether those were payments made on the extended due date that the Commissioner and Treasury extended us last year to July 15th, or whether it's just amended returns where you're choosing to apply the refund claim to a subsequent year. My hopes are not very high that the service is going to get that right. And that's based on countless experience that our firm and myself have had over these past 10 months. I think the vast majority of taxpayers that have simple tax picture, maybe W-2, and they're under the standard deduction is in excess of what the itemized deduction would be for them, they're probably going to have maybe a fairly routine exercise. But I think for clients that have complications with multiple years carrying into 2020, I'm not holding my breath.
Phyllis, you and I have talked about the extension issues before in previous filing seasons. I'm wondering if you share his concerns, or you feel that enrolled agents more generally are concerned or not about the processing of extensions and maybe the expected increase in volume given our current situation.
Yes, I do. I do agree with Ryan. And, when you ask about how the transmission of returns will go, that's one issue. You e-file a return. If it gets through the system without any immediate rejections, that's step one. But then, after that, there is a lot of stuff that goes on behind the scenes at the IRS. Returns get flagged for identity verification. They get flagged for errors. There are various other processing things that go on in the background that can delay. And in terms of what Ryan said about the ordering of things, that can definitely create a big mess. And in terms of extensions, you get another layer of filing. And if you have clients that are apt to have balances due, you want to set up the payments with the extension. So that's another layer of work. So I do think, I and my enrolled agent colleagues and all tax professionals do have some tremendous concern about these issues.
I think it'd be fair to say that most tax professionals believe that electronic filing, processing, and communications are more efficient for themselves and their clients than paper, and that the IRS certainly agrees. The tail that wags the tax agency dog, however, are the millions of taxpayers who, for whatever reason, still use paper, and the IRS's mandate to meet them on their own terms. How much of your practice is still on paper, and for what reasons? Your own, your clients, or the tax agencies? And do you favor somehow increasing the IRS's overall electronic filing mandate of 90% to maybe 99%, or to prepare incentives or disincentives for paper filing to move the IRS forward?
So I have the client side of the practice, and then I have my own personal beliefs or what I'm used to. This is my 25th year, and when I started practice, actually most everything was filed in hard copy, and actually quite a few were not done in sophisticated tax software. It was still done in pencil or even pen that you had to make sure you finalize. But I think the returns were simpler as well, not as many schedules and limitations. So personally, I still file, and it's a pretty voluminous return. It's over 200 pages to federal, but I still file it in hard copy. Part of that is I like filing it in hard copy, seeing it go to the U.S. Postal Service, having certified return receipt, and stroking a paper check. But as a practitioner, I'm obligated to file electronically because of the number of returns our firm files. So it puts us into the automatic e-filing unless the client opts out. I have a few clients that still opt out, but I will say the e-filing and the administrative ease that it provides in most cases is by far more valuable and outweighs the cons or the issues arising. I will say that not all forms can be accepted electronically. It was not until just recently, a couple of years, that non-resident alien tax returns, we call these 1040NRs, could be accepted. And so many times you're FedExing hysterically packages around the world to get an original signature, and then it comes back on A4 letter, which is what the rest of the world uses, not letterhead 8.5 by 11 that we use in the States. And technically that's not an acceptable piece of paper under IRS regulation. So sometimes those would get denied, and then we would have to resend them. If you run an international practice, the e-filing of and acceptance of non-resident returns has been much better. The ability to have a prepare signature that's not original, that helps. But one thing that I think does cause problems is that when you separate the payment from the return, I don't think there's a solution that fixes that, because it used to be the payment went along with the return, the filing. So the payment and the filing were, one and the same. Now we have a payment that is not necessarily with the filing, especially if you have a delayed payment through, a physical check. And I think we all saw that with the millions and millions of unopened mail that occurred, that the commissioner just recently announced on the 21st of January that they finally started and got a grasp of opening most of it, but that doesn't mean it's processed.
That's an interesting perspective on paper. Phyllis?
Yeah, that's fascinating, Ryan, that you still paper file your own return. That's such an interesting perspective. So I think I'm kind of at the opposite end of the scale. I am a big advocate and proponent of e-filing, not only e-filing tax returns, but making payments electronically. And over the years, I think primarily through my work on the IRSAC, the Internal Revenue Service Advisory Council, we worked some issues that really opened my eyes about the burden of both costs and manpower at the IRS for processing paper payments. And so a couple of years back, I just kind of drew a line in the sand for my clients and said, we're making all payments electronically from now on. I'm not giving you estimated tax vouchers except for, your client reference copy. And, I can set up your estimated payments as well as any balance due payments in my tax software. It's very easy. We have quicker confirmation that the payment has gotten where it's going. A lot of my clients are set up for EFTPS accounts, the electronic federal tax system payments. And if they're not, they can use the IRS direct pay. Most of the state revenue agencies make it pretty easy to set up electronic payments on their website if you have something that has to be set up outside of the tax return filing. And I'll tell you, I have never been more pleased with that process than this year, where we had so many cases of paper checks and paper payments being stuck in unopened mail and all sorts of problems associated with that. And, that's not to say that there can't be problems with electronic payments as well. But, one of the things that's great, as with e-filing returns, you do have an immediate confirmation. So you have proof if there's a problem that you've done what you say you've done. So I am a strong advocate. I do hope that we have a stronger mandate for electronic filing, and I would love to see the day when the IRS is able to process prior year refunds as a direct deposit as well.
Interesting. Phyllis, you and many other tax pros have noted to me how important IRS and state tax conformity is, harmonizing deadlines, tax forms, regulations, United States tax law, and how important that is to tax practitioners' practices during filing season. Can you tell me how much time and what kind of work the current state and federal systems impose on your particular practice, and whether and how the IRS or the tax profession might minimize the troubles of tax conformity?
Well, I think the major burden is keeping on top of where the state tax agencies are with tax conformity, both for individuals and businesses. I know New York State, which as a general rule did not conform to a lot of recent tax legislation, just within the last couple of weeks came out with some guidance that, was a big sigh of relief for people who file New York returns, because they are conforming on some of the retirement provisions in the CARES Act and the Secure Act. And we have a lot of issues that we thought were really going to be messes. For instance, if somebody decided to take advantage of the federal 3-year spreading out of a retirement distribution, and if that weren't the case with the state, you'd have issues, not only filing the tax return and reconciling, adding things back on the state return, but also you'd have huge issues with basis going down the line. So, keeping on track of these things, it takes a lot of time. And, something that I looked at yesterday might change today. So I know, having a practice where a lot of people do a lot of different state returns, I'm going to have to make sure to, go and check out those websites before I file anything. And then it's not only a matter of the state taxing authorities, it's how are the software vendors able to keep up and incorporate last minute changes into our tax software. So we've had issues before where it's like, well, I know that this was finalized weeks ago, but hey, Thomson Reuters, that's my tax software vendor, why haven't we incorporated this? And, I totally get it, that it's a nightmare for tax software vendors who have to test all of these things with the IRS, with the state tax agencies, and it's a big issue.
Interesting. Ryan, how does your real estate and cross-border international tax experience compare with Phyllis's, especially considering, at least as far as I understand it, that the US tax professional is more or less at the mercy of foreign authorities over which he or she has no control?
Yeah, so if you have a multi-state practice or even international practice, you really start to understand how jurisdictions and the ability for different jurisdictions to make their own laws, especially tax laws, whether it's conformity or deconformity with the US code, really can keep you on your toes, is the best way I can say it. So for instance, certainly with Phyllis's comment about New York State changing, Virginia's been the same way the last probably 5 to 7 years. I will say that Virginia conformed for the most part, and it was basically, you can guarantee that it was the first bill that was signed in the General Assembly every year, and someone who's championed a number of bills and got patrons and gone through the committee testimony and got things pushed through. That worked, except when you had a changing General Assembly. And if you've watched kind of the political side of Virginia, it's changed. And what happens is although something that to us professionals is supposed to be kind of routine and you would think it would be an easy passage, all of a sudden becomes a bargaining chip. And we're waiting 5-6 months after the year end to even know what the prior year tax laws are going to be, which is what we've been waiting on the past 5 years. Even so, right now, we're still waiting. We don't know what Virginia law is. So I think that, as a practitioner doing the federal side, there's not retroactive treatment at the federal level unless it's beneficial. They're usually not going to do something that's negative on a retroactive basis. But, if you got a multi-state practice, you have 50 states, and that's where you realize like every state can really write its own rules when it comes to income taxation for the most part. And that is a struggle. You have to have a team that's dedicated to following it. What you try to do is get a sense of the clusters of your clients so that you can monitor those clusters on a daily basis or definitely weekly basis. Now, on the international front, it's a little different from a standpoint of They're entirely sovereign countries that have really no obligation to US law. And so when you get clients that have assets abroad, and whether those are business assets or certain types of investment vehicles, a lot of times you're at the mercy of a number of different people. It could be foreign trustees, it could be foreign brokerage or investment advisors, it could be foreign chartered accountants or foreign tax attorneys, or just, having to really push your client to advocate and persuade them to meet the US deadlines, because they have their own separate deadlines and they have their own business cycles. And so that's where it gets a little tough, because in the international piece, not only we have to, take into account other countries' finalization of tax returns and financials and provide that information timely so we can do the conversions to US tax principles. But unlike on the domestic side, when you miss the international filings, there's a lot of statutory, huge civil fines under 6038 and 6039 of our code. And so therefore, it's not just a matter of we just missed the deadline and it's going to be, a slap on the wrist. Many times there's an automatic penalty in the realm of 10,000 or more. And then you've got to fight to get it removed. And then the question is how do you bill that? And how do you collect it? How do you communicate it? So that's kind of the struggle when you've got cross-border reporting for clients.
Has the conformity problem gotten worse with COVID and the economic contraction of the last couple of years?
I don't necessarily think COVID. I mean, I will say the decade of 2000s, it seemed like Congress passed every single year a major bill, and then finally after 2010, there was a little breathing room. It was only every 2 or 3 years. I think what happened is COVID intensified the ability to demonstrate if you couldn't work and be productive in a remote setting, then your customer and clients really saw it. It stood out. And in particular, the service and all of its different departments and even state tax authorities, just having people available to man phones or departments to process POAs. I mean, it just jumped out dramatically. And so the amount of time that we're spending just trying to get the service or tax authority to address our issue, not fix it, just address it so that we can communicate to the client that it's actually going to be resolved, has dramatically gone up. But it was going up anyway at the federal level anyway because of the reduction in workforce at the IRS over the past decade.
Phyllis, what do you think?
Yeah, I would say, definitely, Ryan, what you were saying about the pivoting of the IRS and the state tax agencies, to a teleworking environment, that was a huge, heavy lift. I think particularly for the IRS, where so many of the phone operations come out of wage and investment, which was one of the least telework able business operating divisions, prior to COVID. And I must say, how they got that up and running was just astonishing. And I do think it's kind of fun, when I call the practitioner priority service now and, get to ask where people are and, they sound just snug as a bug in a rug in their basement working from home. That being said, I think, one thing that's happened that's COVID related, at least in New York, is, the state tax agencies are agencies of the state, and the states do have governors, and often the governors have, a political agenda that may be a little broader based and less granular in terms of looking at specific tax related provisions. So I do think sometimes we have seen a little bit of shifting in terms of COVID, and also, the very real issue of, the state coffers in terms of revenue. That's always a big issue.
Support for this podcast is provided by the University of California Irvine School of Law Graduate Tax Program. If you're hearing this, you're clearly interested in taxes, and you might benefit from checking out our sponsor, or you might know someone who will. The UC Irvine Law School offers a 1-year, full-time program that's been ranked the #1 graduate tax program on the West Coast. Students can expect a unique academic experience that combines in-depth doctrinal work and practical perspective to prepare students for successful careers in tax law. The small student-to-faculty ratio also ensures that students get the attention they need to succeed. Applications are open now. For non-US applications, the deadline is April 1st, 2021. For For US-based students, the deadline is July 1st. To apply today, visit law.uci.edu/gradtax. That's law.uci.edu/gradtax.
I'm really glad that we've got two longtime tax professionals here on the podcast to compare and contrast their experiences. And I want to call a lightning round. I'm going to call on each of you by name in turn, and I'm going to mention 10 issues of what we believe are current interest or concern to tax preparers and practitioners during the 2021 filing season. I want your first impressions, thoughts, anecdotes, ideas, or insights about those things, either for yourself, your clients, the IRS and tax administration, the tax profession, or the whole universe in general. I reserve the right as a Tax Notes Today reporter to follow up if you say something particularly intriguing, but in the meanwhile, anything goes. Are you ready?
Yes.
Ready.
Phyllis, IRS Practitioner Services.
IRS Practitioner Services is one of our most beloved and hated resources. Beloved because we really need that level of service that's particular and more specialized practitioners, and hated because of, the IRS resource limitations that often, equates to long hold times.
Ryan, IRS Practitioner Services.
Efficient at addressing simple, complex matters, very inefficient at addressing complex tax matters.
Number 2 to you, Ryan, IRS Processing Backlogs.
The commissioner needs to know what the front line are experiencing, because the message externally is not the same that I hear internally when I speak to the agents.
Well, now that's worth following up. What are you hearing?
Even though all the mail must have been opened, which was publicly stated by the commissioner on 21st of January, the 2 weeks leading after that, I had a number of IRS calls. I try to pick Monday as my IRS call day and line them up, assuming the POAs are processed. And in fact, many of the returns that were filed, and let me qualify that, amended tax returns that were filed during that period leading up to July and even thereafter, although the mail may have been opened, it's not processed. And we need processed tax returns to have the final result that we're doing for our clients, which is finalizing their tax year and that account and any carry forward attributes that go and affect a subsequent tax year.
All right, round 2, Phyllis, please. IRS Processing Backlogs.
I would echo what Ryan said. It's great. Congratulations and kudos to the IRS for getting all the mail out of the trucks in the parking lot and into the service centers. But that does not mean that those returns, payments, correspondence has all been processed. So it's tremendously frustrating as a practitioner, to know, because you have a certified mail receipt or other evidence that something has been received by the service, but have no idea where it is in the pipeline or when you'll get a final resolution. And in many cases, some of these things will impact the 2020 filings as well. So, it's almost like I thought, gosh, does the IRS really need to just stop and get all of this stuff up to date? But, now we're still processing. We have the 2020 return filing season opening up soon. And, maybe some new legislation, it's a lot on their plate.
Phyllis, fraud.
Yikes. The balance between ease and efficiency of, various programs and stopping fraudulent actors, is really tricky. I mean, it's all over the place. It's been, for years with the refundable credits. Now we have, economic impact payments, which probably is not as open to fraud, but we've got, a big one is fraudulent unemployment claims. When people have stolen legitimate taxpayers' identity and filed unemployment claims, often in states where the taxpayer has never lived. So if they're lucky, the state unemployment agency, did a little bit more probing and said, hey, is this really you? And we're able to cut it off at the pass. But in many cases, I have a lot of clients now who are receiving forms 1099-G from, like the Ohio Revenue Agency, Ohio Tax Department. They've never lived in Ohio. They never worked in Ohio. And at least Ohio is sending the 1099-G forms via the mail. Many states don't. So, you could be a victim of this kind of fraud and never know about it until, a year or so down the line when you get an underreporter notice from the IRS. It's a mess.
Ryan, same one word, fraud.
Vigilant. As a practitioner, and actually, I think there was a shift in focus. For many years, the fraud was focused on the taxpayer and trying to obtain taxpayer information, which is a 1-to-1 ratio. You have to go to each taxpayer. And there's been a shift the last couple of years of focusing tax preparer firms. I call it CPA firms, but I understand it doesn't necessarily involve just CPA firms. But where there's a one-to-many relationship, you can go to one firm and obtain a lot of information about many clients. And so you have to be vigilant, whether it's on the personal level, monitoring your credit or having locks on your credit or understanding transactions in various accounts, debit, credit accounts, but also for your clients, but also your firms having, cybersecurity audits periodically by outside independent firms that can tell you honestly what your threats are and weaknesses and reporting on that. You're not going to ever eliminate it entirely. And so what you can do is be vigilant about minimizing it.
Okay. Ryan, round 4 to you to begin with. Your tax practice on COVID-19 in 2021.
Will likely be just as strong as 2020.
Same question to you, Phyllis. Your tax practice on COVID-19 in 2021.
Yeah, I'd say, it's kind of the Tax Professional Full Employment Act. I don't think we're going to suffer for lack of business. There's going to be, in my practice, where I have a fairly one-to-one relationship with my clients because, I am the chief cook and bottle washer. I don't have staff. Many of my clients I've known for years, and, I do have a little bit more of an individual relationship, and a lot of them need a lot of hand-holding. I anticipate that hand-holding is going to be on steroids this year. And, there will be a big issue, even for the individual filers. Do you file now? Do you wait? What are the, really weighing the checks and balances on that, because many taxpayers have other reasons that they need their 2020 returns yesterday, whether it's financial aid, whether they're applying for, PPP loan or shuttered venue operations grants and need their 2020 numbers. So many things. But then, we have some significant proposed legislation. And one thing in particular that caught my eye was a bill that was proposed to exempt the first 10,200 of unemployment from federal taxation on the 2020 returns. So that could be a big game changer for many of my clients. I have a lot of people in the performing arts, almost all of them have collected both regular and pandemic unemployment benefits, and that could really make a difference for them. So, do you have somebody who's got a big refund if they file right away? Do they have a balance due? There's a little less incentive to file right away. But I'm going to have a lot of conversations with the clients about what their expectations are. Do they want to wait? Do they want to file now? And, possibly have an amended return, a lot of issues.
Okay, lightning round 5. Phyllis, Paycheck Protection Program.
Okay, Paycheck Protection Program. Boy, first we had the first Paycheck Protection Program, which had its own set of rules. And we had guidance that, if you applied for loan forgiveness through the PPP, you couldn't deduct the expenses on your tax return, and that created a big brouhaha. And then we had the Consolidated Appropriations Act of 2021 that clarified that yes, you could deduct the expenses that you used for the PPP loan. And oh, by the way, Before, you couldn't apply for PPP and the employee retention tax credit, but now you can, but you can't use the same expenses. And there are all sorts of other things. So, I'm looking at smaller businesses, whether or not they use a tax practitioner, and thinking, what resources are they having to pull away from other business operations to learn about, implement, and comply with these provisions that, have changed pretty dramatically over the past several months.
Ryan, Paycheck Protection Program?
Complex for all the reasons Phyllis said earlier. These are the computations we're having to go through right now to see, it was simple in 2020. You either claimed the credit or, applied for PPP. It was one or the other, it's not both. And it made it very simple. The majority of our clients went with PPP loan applications. Now you have something that's retroactive. It applies for first 2 quarters of 2021, but now you have something that's retroactive, regardless of whether you took PPP. And now you're having to bifurcate, qualifying wages during the time period, but not only on a decrease in revenue, but even if there was a partial or full shutdown, which definitionally that's challenging in certain lines of businesses. And then also, we're still waiting on guidance that our main trade association, the AFCPA, has asked specifically the commissioner and Treasury to address is, can you claim, ERTC on not the same dollar that you use for PPP forgiveness, but the excess, because there was a limit on what you could claim for PPP expense forgiveness. It wasn't unlimited. It was based on a presumed 100,000 annualized salary. And so if someone was paid more than that, could that excess? And what did they use for their testing period? Was it the 8-week or 24-week? So that question has not been answered. So what does that mean? It means clients or taxpayers have to delay and pause and wait until we get that answer. And so all of those calcs, they take time. You got to pull the data. In the meantime, we're trying to do, get geared up for tax season for the current year. So like I said, it's complex. My gut is the majority of clients that took PPP, probably it's not significant, especially if Treasury and IRS come out and say that you can't use any of the wages during the testing period that you use for loan forgiveness on PPP.
Ryan, to you, 6th round employee retention tax credit.
Who pays for it?
Understood. Phyllis, employee retention tax credit.
Complex. Ryan, well put.
Ryan, $3,000 child tax credit.
Seems excessive unless you reduce the income threshold for qualification. And again, there's an acute section of the country that really has been devastated by this. I think it's more in the travel, leisure, retail, more of the retail merchants, not necessarily the big box retail, but small retail, mom and pop shops, and then obviously in-dining restaurants for the most part. And obviously the employees that are employed by those establishments. But there's also a lot of businesses that have actually performed well, and a lot of probably individuals as well, because they're not paying commuting cost, they're not entertaining and doing leisure activities. All of that is cash flow. I think I saw it was either a NerdWallet or some kind of financial report that cash savings is at an all-time high in the US. And so part of me thinks that, people are not having the ordinary spend that they would normally have in a post-pandemic or even pre-pandemic. And so at what point do you really need to continue to basically exhaust the Treasury or the US balance sheet? That's my concern.
Understood. Phyllis, $3,000 child tax credit.
Yes, I do have a client base where more of my clients would be underneath the phase-out limits and able to take advantage of this. It's a big change, and it will require being paid for, as Ryan said.
Ryan, 8th round, a 3rd round of economic impact payments, $1,400 each.
Yeah, my thoughts are, if you're going to do a 4th round, make it very acute and really narrow who can qualify, whether it's a business or an individual. My thoughts is, if you're coming out of pandemic, just the natural process of coming out of like a recession, things are going to get better and you should be experiencing that. And so typically that's when the government eases off the accelerator.
Okay, Phyllis, 3rd round of economic impact payments.
Right. I agree with a lot of what Ryan said. It's very difficult to determine someone's need simply from numbers on a tax return. I mean, I think that's always been the case. There are people who have very low adjusted gross incomes and taxable incomes who actually are doing quite fine and, are probably putting these payments into savings. There are other people who look on paper like they would not qualify, and they're so-called higher income that are actually suffering greatly. So it's really tough. I know that there's not a way to exercise more judgment than that from the IRS or the Treasury's perspective, because they simply don't have a lot of the information.
Fourth round of economic impact payments. I repeat, Phyllis, a fourth round of EIPs.
I would probably repeat my answer. I think maybe we really do have to look at lowering the thresholds. But again, you're never going to be able to have a simple answer that's going to apply to everyone fairly.
Final round, round 10, to you, Ryan, first. April 15th.
Will it get extended again, just like last year's extended deadline that was moved to July 15th?
You believe it will be that way again?
No, I don't. I'm leaning towards it's probably not. There probably would have been guidance by now, or at least some kind of indication in addressing the public that they were at least contemplating it. And I haven't seen that. So I don't know whether it's going to be done, but if I were hedging, I would lean towards it's probably not.
Okay. Phyllis, April 15th.
April 15th, a date etched in my forehead. I would not be surprised if we had another extension of the April 15th deadline. I can't remember exactly. I think it was mid-March that they announced the extension of April 15th last year. I think it was right before the March 15th business filing deadline, and everybody was kind of laying odds on whether that business deadline would be extended or not. So I would not be surprised if we had an extension, whether it's till July 15th or, whether it's a month or June 15th. I wouldn't venture a guess on that, especially if we have new tax legislation and other things that impact the IRS in terms of programs that they have to implement and administer. The filing season, which is always quite short, seems to have gotten shorter with the February 12th starting date. And I think extending that deadline past April 15th will give a lot of practitioners and taxpayers breathing space and allow them the quote automatic extension without having to do additional filing to achieve it.
When and if this pandemic is over and people can gather in public again without fear, what will be the first conference, association, or tax-related event you'll be attending, and why? Ryan?
I don't have any in-person conference planned through the remainder of this year. And I usually plan my calendar out 6 to 12 months. There is a national tax conference that I typically speak at every single year. It's the first week in January. This year's it was virtual, and it's the Prime Global National Tax Conference. And so I look forward to seeing colleagues in that, because it's a lot of partners from other CPA firms around the globe. And it's the one time where we can all come together and basically address pending legislation, new legislation, and the upcoming filing season, corporate, partnership, individual, trust, estate. I look forward to that because I've developed a lot of strong relationships with friends and colleagues, and we tend to do a lot of fun things in the after hours, after 3 or 4 o'clock each day, and we break from session. And unfortunately, it was all virtual this year. And so it's nice to be able to click and go to a room virtually, but at the end of the day, you're still sitting in your home office.
Yeah, well, here's to hoping that's over soon. Phyllis, in that spirit, what will be your first in-person event?
I've typically attended a lot of in-person events, and I am a big fan of the networking, and a lot of the learning happens outside of the actual conference sessions, and in the bar or restaurant or in the lobby. going out and doing various activities. So I would say, one of my big regular conferences that I've been attending in person for years is the National Association of Enrolled Agents National Conference. And they typically have a couple of events. What I'm seeing with a lot of things is, sometimes they're announcing in-person events, or they did announce in-person events several months ago, but as things unfold with the pandemic and the vaccination process, they're rolling back and saying, nope, we can't do this live. We have to do another year virtual. A big example of that are the IRS forums. I think that they were really hoping to be able to go back to a live venue for those forums. And, they attract huge numbers of tax practitioners from all over the country. They have just recently announced that they're going virtual. And, as a leader in the New York State Society of Enrolled Agents, we have a contract for a virtual conference in October. And, at this point, it's really a tough call, what will be happening in October.
Phyllis, are you concerned in any way that this pandemic may go on so long that it will change people's desire to meet in person, and that virtual will become, if not the only way, then the first way that people decide to meet?
Well, that's a really interesting question, because even before the pandemic, what I see, both at the conferences that I attend, and my other half is an attorney and very active in the Maritime Law Association. I think that the emphasis that firms have on sending people to live conferences has dwindled over the years. So up until the pandemic, we've kept the model of the live conferences, but really struggled with attendance. And then, as younger people are coming into the profession, they are so well versed in the virtual world, and they have kids, and they can't just pick up and go for 3 days or 4 days to travel. So I've been hearing for years, I'd love to attend this, but I can't afford it. I can't take time off. I can't leave my kids. I can't take my kids with me. All of these things. And for a profession that, at least from the enrolled agent side of things, tends to be a little bit on the older side, it's been really heartening to see how this pandemic has really pushed people who never would have attended a Zoom conference and who really didn't like webinars very much. The necessity of having to do these things has really pivoted a lot of people. So I would say, even if we go back to in-person events, I think we're going to really have to be looking at hybrid or recording the in-person events, because, there's a huge population of people that don't really see the value in attending live events and or cannot afford to attend them. And, if we disenfranchise those people, we're kind of cutting off our noses to spite our face.
Ryan, what do you think?
I'm a relationship kind of guy. I enjoy the interaction inside the conference and as well as outside the conference. I miss being able to shake people's hands, put an arm around their shoulder, or hug them, or smile for a picture, to put on that. Most of the ones I go to, they're streaming live, so they're trying to let their viewers know what's going on at the conferences. I think if you're in more of a development role for whatever business that you're in, whether it's professional services or not, you're still going to want to do the in-person. But if you're strictly going for like CPE, I think that ship sailed many years ago. I know majority of the CPAs and attorneys in my firm, we subscribe to basically CCH webinars, and we've fixed the fee for CPE and CLE on an annual basis, and they have excellent CPE and CLE. But, a lot of folks don't necessarily look at trying to build relationships amongst companies and customers and stuff like that. So I think there's always going to be a desire for those that are on the front line representing their organizations and trying to drum up business or referral relationships or whatever you call it. We call it business development. I think that'll continue. My gut is that when this kind of pandemic really does open up, and I don't mean open up temporarily, I mean open up where it's free travel around the globe, I think there's probably going to be a massive uptick. But what I don't know is like, when is that collectively, is everyone going to feel comfortable and safe? Maybe you show your kind of card that you do when you go to other countries, like, you have to get your typhoid shot and you show your yellow card, or that you've been vaccinated for, malaria or whatever. I don't know if there's going to be a coronavirus card that you have to show, but I would think, just human nature is we like relationships. We like interacting with each other. We're social people, and doing that on a screen or on a phone or on a laptop or on a tablet, it just doesn't replace it.
Okay. Ryan, Losi, Phyllis Jo Kubey, thank you very much for joining us. I hope you had a good time. I did.
It's been a pleasure. Thank you. Really a lot of fun.
Bill, thank you again very much. Enjoyed the session.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now from his home is Executive Editor for Commentary, Jasper Smith. Jasper, what will you have for us?
Thanks, Dave. In Tax Notes Federal, Frank Agostino and Eugene Kerman explain the tax benefits available to service members and veterans. James Wittenbach analyzes the tax credit for new all-electric vehicles. In Tax Notes State, three practitioners with Pillsbury, Winthrop, Shaw, Pittman explore the recent Delaware court decision of VeriSign and what it means for taxpayers. Four professors argue that if New York's proposed state billionaire Mark-to-Market Tax Act is enacted, it should be upheld against any constitutional challenge based on retroactivity. And on the opinions page, Robert Goulder examines the new restrictions on anonymous shell companies under the Corporate Transparency Act. Marie Sapiri examines New Jersey lawmakers' arguments for repealing the limitation on SALT deductions as a means of pandemic relief. And now we'll take a closer look at what's new and noteworthy in our magazines. I'm here with Paul Crispino, an international tax attorney with 2 decades of multinational experience, including serving as Associate Tax Legislative Counsel in the Treasury Office of Tax Policy. Welcome, Paul.
Happy to be here.
Excellent. So today we'll be talking about Paul's upcoming article, which considers the potential future of market-based taxation through the lens of a 2014 Indian tax case involving Volkswagen Finance and the offshore advertising activity of actor Nicolas Cage. Paul, could you tell us a little bit more about your article?
The case actually involves Audi India, which is a distributor of Audi vehicles in India, and Volkswagen Finance, which finances the purchases of those vehicles. Those two companies were waiting for the new launch of a vehicle targeting the Indian marketplace, and they were hoping to do a nice promotional spread for it. But the car was not yet available in India. So they decided to hold the event in Dubai, in the UAE, and that's where the car was. So what they did was they flew in 150 guests, as people who were journalists and prospective buyers, into Dubai. And the centerpiece of that event was a 3-hour appearance by the American actor Nicolas Cage. He was driven up to the event in the vehicle. He was interviewed by an Audi India representative, and then he mingled with the guests. And for that 3-hour appearance, he was paid $440,000 US plus cost. Now, the two companies, Audi India and Volkswagen Finance, they deducted the cost of the promotional event on their Indian tax return, which makes sense, right? Because they're Indian companies and this is, part of their business. But they never withheld any payment on the $440,000 they paid to Mr. Cage. And on audit, the auditor found that that payment was actually a royalty and subject to withholding tax. That decision was appealed to the appeals office in India, and that was upheld by the appeals office. Ultimately, Volkswagen Finance, which is the named party in interest, they appealed that decision to the tax tribunal in Mumbai. And the tax tribunal ultimately upheld the government. And it did it not on the basis of a royalty, as you would have thought, because that's what the auditor found. Instead, they believe that the payment was an Indian source payment. And to get an Indian source payment, you need to have nexus. So the real question became, well, where is the nexus between Mr. Cage's activities in Dubai and the Indian business that he was supposed to have a connection to? Well, the tribunal spends a lot of time in the decision focusing on the business activities of both Audi India and also Volkswagen Finance. And it finds that they have a very close connection, and their business connection is such that under the Indian law, which has a rule that says you could deem activities to have arisen and accrued in India to the extent there's a business connection, the tribunal finds that rule applicable because of the business relationship that the event had to the two sponsors' business. Now, the problem with that conclusion is how does that make Mr. Cage having that business connection? Because that was what the law requires. It requires that Mr. Cage has that connection, not the two sponsors. And that was something that was brought up by the Volkswagen Finance during the trial. They said, well, how could it be that Mr. Cage, who performs services, is pulled into the Indian tax net based on a sourcing rule? And they pointed to the existing authorities, which basically cite the international norm that services are based and sourced based on whether activities occur. And what happened was the tax tribunal decided, well, those old case law that dealt with bricks and mortar companies, they don't apply in the international rules now, given the digital economy. So they were looking at the new way of doing business, and they said those laws don't apply. It's a case of first impression. When you step back from that decision, there's, I think, two real issues with it. First, there's a real risk of someone like Mr. Cage being subject to double or even triple tax. Remember, Mr. Cage is a U.S. citizen and a taxable resident, so he had to pay tax in the U.S. on that income. The real question was, could he get a foreign tax credit for any withholding tax paid to India? And the reality is, if you go back and look at the September 2020 regulations that were issued by the U.S. Treasury Department on foreign tax credits, they now say that you would need, and these are proposed regs, of course, that you would need a jurisdictional nexus based on international norms. And those norms, as I mentioned, are based on having services sourced at the location of where they're performed, not where the recipient is. So in theory, he would not be able to get a foreign tax credit from the US government, and he'd be paying tax in the US and also in India. So I think that's one of the significant issues with this case. And the second big problem I think I have with the case, as I mentioned in the article, is that this is a court decision. This is not a legislature making this decision. And even though they may have looked to existing Indian law, they stretched that law beyond reason, right? They stretched it to include things that were outside of international norms. And what we need really to do is have an international consensus on this type of activity. And it's interesting that something I mentioned about international consensus, because if you go look at Pillar 1, the blueprint that was issued in October, there's a paragraph there, 525, and you'll see that it states certain inclusive framework members are looking for a result exactly the same as what the tax tribunal found. They're looking for a result that says, if you have targeted marketing activities that are performed outside of the market jurisdiction, they believe that the market jurisdiction should have the right to tax those activities. And you say, well, that's obviously a big change to international law. The rationale they give for that is that if you don't do that, multinationals will have an incentive to perform these remote activities and advertisements in low tax jurisdictions. So some members of the inclusive framework, which I suspect probably includes India, are looking at this through the lens of an anti-abuse rule. But that, of course, is part of Pillar 1. And unlike a court decision, it's something that will be subject to international consensus. How does this relate to Pillar 1, right? I mentioned that paragraph 525 is one way. The other way is I think you could analogize Mr. Cage's activities to those of a consumer-facing business. Remember, what those businesses do is usually they produce goods or services, and then they use independent distributors to distribute those goods to different marketplaces. Well, if you look at Mr. Cage, what did he do? He produced, advertising with his image, and then a distributor, in this case, Audi India and Volkswagen Finance, they took his image and marketed it in India. And even though I think it's pretty well settled that he knew that was going to be used in India, you could have a consumer-facing business that doesn't know what the distributor will do with its goods. And then that consumer-facing business under Pillar 1 would be pulled into these different jurisdictions by fact of this independent contractor and distributing the materials in a jurisdiction that you didn't even know they were doing. So I think that's another aspect of this case that will definitely come up in the future.
Thanks, Paul. We certainly appreciate that summary. And it really was a summary because you examined those points in a very thorough manner and came to some very powerful conclusions, if you will. So I'm intrigued to see what our audience thinks of it and certainly the type of feedback that you get. In line with that, if someone wanted to reach out to you, where might they find you online?
Well, you could find me on my LinkedIn profile.
Okay, so just Paul Crispino on LinkedIn.
Yes, you'll find me there.
Excellent, excellent. And of course, you can find Paul's upcoming article online at taxnotes.com. And be sure to subscribe to our YouTube channel, Tax Analyst, for more in-depth discussions on what's new and noteworthy in tax notes. And again, that's Tax Analyst with an S. Back to you, Dave.
You can read all that and a lot more in the pages of Tax Notes Federal, State, and International. That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at Tax Notes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk. Tax Analysts, Inc. does not provide tax advice or tax preparation services. Nothing in the podcast constitutes legal, accounting, or tax advice. A full disclaimer is included in the transcript.